but still. Rent is an example of fixed expenses. Yes, yes, you're right, Elizabeth and Julia. Depreciation of coffee machine, definitely. And variable expenses, what could we find here? What could be increasing or decreasing with the increase of number of cups of coffee sold? Materials like milk and coffee, Polina, Elizaveta, thank you very much. Yes, you're right, Ksenia. Rent administration salary is a fixed. Yes, yes, milk and water variable. Thank you, girls. Thank you for your answers. Now we have to estimate the total cost and average cost per cup of coffee and the indicated levels of activity. You see that we have 3 weeks here and different levels of activities. As we have discussed during previous practical sessions, activities are some actions of companies that drive our costs. So activities in this case are number of cups of coffee served, because number of cups affect the overall expenses and variable expenses, and therefore they are our cost drivers. So how can we estimate the total cost? It's clear that fixed expense is paid every, or is recognized every week, and our variable cost is recognized with any additional cup of coffee sold during the week. So how to perform this? This is a solution of this exercise. You know that total cost is calculated as variable cost multiplied by activity level, and to this value we add our weekly fixed expense, and therefore total cost is the arithmetic sum of those types. And we divide this total cost by number of cups of coffee, and we assume that the total cost is going down with the increase of number of cups, because the economy of scope is live here, and we can see that fixed cost proportion is decreasing with the increase of number of activities. So this is a common rule which is used while yes, okay. You have calculated for 3 weeks in total. And my solution is for separate weeks. Yes, Elizaveta, thank you very much. Your solution is great, but for the total period, not by weeks, but in total. So we can see here that this economy of scope could be used while you decide how many items to produce. Of course, it should be balanced with the demand to the product, and it should be balanced with the relevant range, because you know that after specific volume of activities, our fixed expenses became not so fixed as we expect, but they moved to another level, to a more high level, and we have to recalculate all our values in order to understand the real numbers, because our fixed expenses are fixed. It's a linear assumption of fixed expenses, but only within the relevant range. If this range is if our production is overcoming this upper limit of the relevant range, we need to calculate fixed expenses from the beginning. So from here, we'll move to the next position, which is the mixed cost, and how to allocate the mixed cost. Actually, mixed cost contains both variable and fixed elements. You know that if we use utilities or electricity, part of the payment is related to the ability of the firm or physical person to use this electricity. And the second part is related to the kilowatt hours consumed during the period. And that's why almost all utilities are mixed costs. And we have to divide or split the bill to fixed and variable parts to be able to allocate our expenses correctly, because sometimes a variable part of utilities could be assigned to variable expenses and, of course, fixed part to fixed expenses. For example, if you have the chemical production and use electricity for electrical process, which drives the chemical processes, and therefore electricity is included physically to the final product. Of course, these variable expense could be included into direct materials and used as a normal variable expense. If, for example, we produce something like accounting service, for example, we use electricity only to drive our equipment, to light the room, and to heat maybe the room as well. And in that case, electricity would be the expense, the fixed cost that is related to the period cost only. So the classification of the same expense is very specific for different industries and for different types of business models of the companies. So how to split? We have to use several methods to split our mixed cost to fixed and variable parts. And here I want to present two basic methods. The first one is the high-low method, which is used to split mixed cost to variable and fixed parts in case we have no many data points to do this job. If we have only several measurements, for example, we have an annual bill where only quarterly data are presented, so we can use the highest and lowest activities to evaluate the part of mixed cost, which is associated with variable cost per unit. So this abbreviation included in the formula is variable cost per unit, which is equal to the difference in activity cost divided by the difference in activity levels measured in units. Therefore, we can calculate the variable cost per unit. And the second very popular method is the regression analysis. We can apply this if we have a yearly bill, for example, splitted by month of activities. In that case, we would have an ability to apply the regression analysis, as this analysis requires more than 7 points per each variable, and therefore OLS could be used only if we have more than 4 quarters in our electricity bill, for example. And in this case, we just use the ordinary least square approach in Excel or any other program, or even manually, to obtain this coefficient B1, which is actually variable cost per unit, equal to the variable cost per unit from the high-low method. Actually, they are not always equal, but they are very similar. how to choose between methods. If we have data to apply regression analysis, we have to apply this. If we have no data, we apply the high-low method because it's less accurate and less precise. This is an example of regression analysis used. So you can see that a regression line is representing the fixed cost by the constant, and a regression coefficient stands for variable cost per unit. And the dependent variable meaning is actually the amount of utility bill. So it's the amount of our mixed cost in total. If we can use the high-low method, I'm sorry, I don't know why this heading is doubled, but anyway. If we use the high-low method, we know that we have lack of data. We have only 3 months here, and we have to calculate the amount of total cost for April if we expect to produce 7,000 units in this month. So the first step, we identify the highest and lowest activities. So we use units here to identify the level of activities. So then you apply formula. In a numerator, there would be the difference between cost associated with the highest and lowest activities, and in denominator, there could be the difference in activities. And the result would be variable cost per unit. Then we apply this variable cost per unit to the highest level of activities. So we multiply 2.5 by 6,000 and extract from the total cost. And the difference would be the fixed cost for the period, which is assumed to be equal for each period. Then we calculate what we can expect in April. We took our potential activity, which is within the relevant range of production, multiplied by the variable cost per unit, and sum up with the fixed expense and predict our total cost, which should be equal to 32,500 if we assume to produce 7,000 units in the next month. I think it's clear how it could be used. If no, please ask your questions now. So first of all, is it clear that we cannot leave mixed cost unsplitted at the end of the period? Is it clear that we have to do this split because we need to assign our fixed and variable parts of the costs correctly to specified accounts? Mm-hmm. I suppose it means yes. I think it's clear that.
Excuse me, I have a question. And why do we use the highest level when we calculate fixed cost?
Actually, this formula is organized in such a way that we can use any month to calculate the fixed cost because it should be equal in each week. I think the historical use of this formula assumed that we would be using the highest level of activities. But actually, it should be equal in each month to the same amount because this cost assumes to be fixed. For example, if we would be using the lowest value, so we multiply, so lowest value is 4. where we multiply by 2.5 and extract from 25. Again, 15,000. So it should be true regarding each period.
Okay, and why do we multiply the 7,000 in step 4? We don't have this number.
2.5 we have calculated from the formula a variable cost per unit. So we splitted mixed cost in order to understand what should be our variable cost per unit and the fixed cost per period. So we have found that variable cost per unit is $2.5. If we plan to produce 7,000 units in April, we calculate variable cost for April because we need to predict our total cost for the next month.
So it is just 7,000. It's a number that we will have in April, yes?
Yes, we
Of
plan
units.
to have it
Okay.
in April. So it's
Thank you.
stated in the text that company expects to produce 7,000 units in April. And this company wants to know what would be the new volume of the total cost in order to understand how to organize this business. Thank you for your questions, and maybe more questions about this. So we can look for this total table that I've been prepared for you. Total cost is total cost could be calculated as cost per unit, for example, and fixed cost is constant in total, but changes proportionally with output. Our variable cost changes proportional with output, but mixed cost change with output, but not proportionally. So how to define which cost is given to you? So we have to see how they behave, and therefore decide what type of the costs we can see here. Fixed cost decreases with increase in output because the proportion of the fixed cost to each item would be less if we produce more with the same level of fixed cost. Variable cost is constant per unit because we cannot use less meat for hamburger, for example, or less wood for the table. Mixed cost decreases with increase in output, but less than the decrease in fixed cost per unit. So mixed cost could be summarizing features of two types. For examples of fixed costs are depreciation and property taxes, variable costs like raw materials and wages, and mixed costs are represented by telecommunication costs, salaries, transportation costs, and many others. So first of all, we have to summarize our cost classification principles. So to assign cost to cost object, we use the first classification to direct and indirect cost, and later those could be split to variable and fixed. For decision making, we often need alternative estimations like a differential cost, opportunity cost, and a sunk cost. So here you can see the cost flow in a production company. I think you remember that our cost flows from the raw materials purchase till the cost of goods sold recognized and revenue recognized in case of selling our goods and services. So we will use the same cost flow model, but use it in a more detailed way, splitting to several categories in order to understand better the cost of goods manufactured and cost of goods sold. So our task, the task of costing method, is to understand better the nature and behavior of the cost, and the basic value chain is presented here. Components of the total cost on each stage of this value chain. First of all, we took direct materials, labor, and expenses. It is a prime cost, you know. If we sum up our work overhead or factory overhead to prime with the prime cost, we can obtain work cost or production cost. If we add to this volume office and administration expenses, we can calculate cost of production. If we sum up it with the selling and distribution expenses, we can calculate the total cost. So we have several steps in calculation of the total cost, and of course each step could be managed very carefully in order to understand the correct value of the total cost, because cost is the basis of the pricing strategy of the company. It is the basis of some decision-making policies. For example, your manager's bonus policy may be related to the total cost and total cost differences that could occur during the period. So components of the total cost are very important here. How to use the cost data for decision making? Let's see it in details. First of all, we have to make several types of analysis. Activity-based costing techniques. We apply these activity-based techniques in order to calculate costs or cost of units more accurate, and in order to understand what products to produce, what products to sell, which product is bringing more revenues and more profit to our company, and even which customers are more or less profitable. For example, we can calculate our activities not only from the production point of view, but also from this customer service point of view, and we can understand the activity of each client and the use of this activity in our profit generation process. Make or buy analysis is also very important here. We use costing information in order to understand whether we have to purchase the specific material or maybe specific spare part for our products, or purchase it from outside. For example, each company decides whether to use outsourcing, for example, for accounting services, for cleaning, for packing our products, or we can do all these functions using the own personnel, and we need not the outside companies to support our business. So all these solutions are based on cost analysis. That's why it's so important, and the basic and cost analysis is the basis of management accounting. For decision making, we can split our cost to relevant and non-relevant costs. Of course, this split is a very subjective one. Relevant costs are the costs that meet this requirement of good management accounting information. It is appropriate to a specific management decision. So if it's so, our costs are relevant. If it is not, costs are not relevant. For example, if we want to attract more customers, we may organize some advertisement campaigns. For example, we can order some advertisement from the blogs, and our relevant cost would be the payment to bloggers, payment to influencers, for example, or giving them our products in order to get more feedbacks, in order to get more promotions of those products. In that case, they would be relevant. If we know, of course, that our target audience is watching those influencers, is reading their blogs, and so on. But if we would decide to spend money for TV advertisement, but we know exactly that our target audience is not sitting before the TV screens and never could see our advertisements, so these are non-relevant costs because they are not associated with the target audience activities. So, of course, in this case, marketing department and cost analysis department could work very closely in order to develop the concrete marketing campaign and associate the higher profit with higher cost. So, could you please tell me which one would be irrelevant cost for the Baskin and Robbins, and why do you think so? So how do you understand this definition of irrelevant cost? I have one answer, and of course you're right. This cost is irrelevant because it's purchased by mistake, and we need not this product to produce the finished good. Okay. One more example how to use costs classifications for decision making. You can see this Nature Way cosmetic firm, which is thinking about its marketing methods from distribution through retailers to distribution by a network of neighborhood sales representatives. So they decide between two potential opportunities. They have calculated potential revenues, cost of goods sold, and different types of costs from retailer distribution and from representatives, and to calculate the differential cost. So differential cost will tell us about the difference between our current method of distribution and proposed method of distribution in order to decide whether our new system would be profitable enough. So here we can see the current cost associated with retailer distribution, the opportunity cost associated with representatives, and differential cost. That means the difference between current and opportunity cost. So we can see that in case of switching our distributional system to a new one, our net operating income will increase by $15,000. Therefore, the new system would be effective. And of course, if we use the data for decision making, our solutions may be more balanced and more reliable to the current situation. So before we decide to switch to a new system, we have to analyze all potential expenses and potential increase in revenues. So this is the example of cost classification used for decision making. One more example is related to calculating critical costs. In some cases, we have to determine the most important factors with respect to cost in the business and calculate the critical cost. Critical cost means that this is a value which allows the firm to produce products that provide profits. If our current expenses, I mean the total cost per unit, would be bigger than the critical cost, our products became unprofitable, and therefore company is losing the potential income and potential revenues. Sometimes critical cost is defined from the situation within the organization, but sometimes from industry averages. When you compare your products with the products of your competitors and decide what would be the maximum cost of the product in order to keep the current level of quality and the current level of competition within the industry. For example, if you want to increase the quality of your products, let's take some very common products like I don't know, a plastic bag, for example. If you want to increase the quality of this plastic bag, for example, to make it from natural materials, for example, you have to understand what would be the highest level of the cost per unit in order to keep your plastic bag within the range of products, within the range of similar products produced by other entities in order to maintain the level of demand to your plastic bags, for example. Because if your plastic bag is natural and good enough, but it has the cost that is bigger than the average price per this plastic bag, your bags would be left in shops, and therefore it's not effective to produce and sell them. So there critical cost may be the threshold which fixes your potential level of spendings and keeps your business within the specified limits. If we analyze the potential cost or actual cost and define the fixed and variable expenses, we have to create the contribution income statement in order to understand, first of all, what is the proportion between the contribution margin and the revenue, what is the proportion between variable and fixed cost, and how many items we have to produce in order to keep our business safe. So this contribution income statement is also used to provide the cost volume profit analysis and sensitivity analysis. It is used for segmented reporting of profit data, is used in budgeting, and also for special decisions like pricing strategy and development or make or buy analysis. Let's see how to create this. I think it is already clear from the first practical session that here we have to calculate not a gross margin, but the contribution margin, which is the difference between sales and variable expenses. Of course, our traditional and contribution formats could provide the same net operating income because it's reported. And it is an actual value of our net operating income, but still the split of expenses is a bit different. And we have to understand here not the division between cost of goods and administrative expense, but the split between variable and fixed expenses. This will give us additional information regarding the potential increase of level of production, regarding the potential impact of each product to the total net operating income, and so on. So let's see the example how to calculate this contribution income statement from the very beginning. Let's return back to our entrepreneur who makes t-shirts with some postmodern slogans. We have to prepare the contribution format income statement for the particular period, which is a month. And we have some data in table, number of units, selling price per unit, variable selling expense per unit, variable administrative expense per unit, fixed selling expense, fixed administrative, and the information regarding merchandise inventory. So what should we do here? First of all, we calculate sales. We multiply our price by number of units. Then we sum up variable expenses and calculate our cost of goods. Then we calculate sum of variable expenses, yes. Then we calculate contribution margin, which is equal to sales minus variable expenses. Then we calculate fixed expenses and net operating income. And then we prepare the form. And let me highlight that this form should include, first of all, the name of the statement, the name of the company, the period for which you have been developing this report. Then if we use the two-step income statement, we have to use two columns. In the first column, you can use intermediate values and provide intermediate calculation, but the second column is devoted to the finished calculations, and you can place all the expenses to the form and calculate the net operating income. So if your task during the final test would be to provide the contribution format income statement, it should be represented in a similar way. Don't forget about the specific parts of this report that we have to provide the headings, the period, and the correct calculations of our values of fixed and variable expenses. Any questions about this part? Is it clear how to develop this contribution format income statement? Is it clear that we use administrative expenses in variable and fixed twice because we have different categories of variable expenses? So administrative expenses could be also variable and fixed. And in our case, we have two of them. And that's why we use these names two times. Any questions about this case? If there is no questions, let's go to the next part of our today's presentation. It is a cost volume profit analysis. As I've already said, the contribution margin calculations could be useful for cost volume profit analysis or CVP analysis in short. The highest part of the cost volume profit analysis is the break-even analysis. Break-even analysis entails the calculation and examination of the margin of safety for an entity based on the revenues collected and associated costs. So we can use break-even analysis for pricing. We can use it to decide whether to introduce a new product or service, open a new plant or not. We can use it to identify whether it's needed, whether we have to modernize or automate an existing plant, whether we should change the cost structure, and in many other cases as well. So break-even analysis is the most efficient part when we decide to analyze the cost behavior and its influence on the results of our business. How to perform the break-even analysis? First of all, we calculate fixed and variable costs. I think you now can do this very briefly. Then we find the connection between revenue and costs. So if we have to understand what are relationship between our revenues and costs. So we should extract factors that affect profit, for example, volume of production, prices, costs, and changes in product mix. Product mix means the production portfolio, so set of specific items that we decide to produce and sell. And we calculate profit volume ratio, which is the ratio of contribution to sales, which indicate the contribution earned with respect to 1 unit of sales. So there you can see two formula that could be used to calculate this profit volume ratio. And let's see the example. On step number 3, we calculate the contribution margin and this ratio. So PV ratio is the relationship of the contribution margin in total and sales. So actually 0.25 means that each dollar sales will bring us 25 cents of contribution. Not profit, but the contribution. Because it's important to calculate, because the contribution is the source of initial development of the firm, because we can, for example, somehow reduce the level of fixed cost, but we cannot reduce the level of variable cost dramatically. And we have to understand what would be the contribution that allow us to develop the business in total. And break-even analysis is also the analysis of the relationship between total cost and revenue. We have to calculate two basic lines. We have to develop two basic lines. This green line is the total revenue, which we calculate from the output. So we assume that if we produce 100 items, so which would be the level of revenue? If we produce 200 items, how our revenue will change? If we produce 500 items, what would be our revenue? And therefore, this is a linear approximation of revenue. The same we will do with the total cost. If we produce 100 items, so what would be the level of total cost? And therefore, we draw this blue line, which is representing the total cost. And the break-even point is the point where our lines are crossing, where we have the common point of those two lines. This is a point of equilibrium, where our total cost is equal to our revenue. Break-even point means that we have to produce more, but not less than this break-even point to save our business. Let's see the example at the right. If we assume that Pierre's photocopying service charges 0.10 dollar per copy, and fixed costs are 27,000 a year, and variable cost 0.04 per copy, we can calculate the break-even point in the number of copies. So we calculate in brackets the contribution margin per unit, so 0.10 minus 0.04. So 6 cents is the contribution from each photocopy. And then we divide our fixed expenses by this contribution, because the contribution margin is the source of development of the firm, and it should cover all the fixed expenses as well. So we should produce 450,000 copies per year. In that case, this business would be safe from bankruptcy. If they produce less, this business would be destroyed and closed. So break-even point is the point of equilibrium. We cannot produce less. Actually, break-even point is calculated in units, but it could be calculated in dollars if we are speaking about service companies that are producing services and cannot compare one client to another client, because services are different and maybe they are customized, and we cannot compare 1 hour of consultancy, for example, to another hour of consultancy because they are individual. For those firms, we can calculate break-even analysis in dollars. And in that case, break-even point would be giving us the information about the minimum revenue that this company should collect for the period in order to save the business. And if you return back to our graph, we can see this yellow field here, which is the loss area, and this green field, which is marked green, is the profit area. So if we produce more than our break-even point, we can calculate the volume of profit that represents the difference between the total cost and the total revenue. So this how the break-even analysis could be used. It is actually used in business planning, in future forecasting. For example, company could calculate new break-even point every time it changes their product mix. Every time it changes prices, and every time the situation on the market is dramatically changed. For example, due to lockdowns or due to some external problems, sanctions, for example. So we can do this break-even analysis at any moment of time we need. Any questions about this part of information? So do you have any questions about break-even analysis? And cost volume profit analysis is the common name of several instruments like profit to volume ratio calculation, break-even analysis calculation, sensitivity analysis. Sensitivity analysis means that we calculate the several break-even points, assuming different scenario. For example, scenario 1 will include the increase of prices for materials and decrease in demand, and you calculate the break-even point in this case. The second possible scenario may be related to the opening a new factory, and you can calculate the new break-even point for this scenario. So sensitivity analysis means the difference in break-even points despite of the scenario that is planned to use for the future. So I suppose this topic is clear. If some questions will be ended, so please use the chat and ask. And we will be moving to our new topic. Job order costing and process costing. So now we should discuss how to use specific costing systems, because I already said that different types of costs are used under different costing systems, and costs are not equal, and different business models require different costing systems. And now we have to discuss how to choose the proper costing system. But of course, we can't cover this topic during one lecture. We have to continue next time. But we start from the most popular system, which is named the job order costing system. We still are here on the first part of our course. And before we start, we have to discuss what is the cost driver and how to select the proper cost driver for the business. You can see that different products could be using the same materials, the same labor. So our entrepreneur may identify that mobile phones and computers may be made of similar spare parts and materials. But if, for example, company makes different products for different clients, how to split those expenses and how to decide which order require what portion of indirect expenses and how to assign this indirect expense to specific products. So if the factory makes a range of different products, those products might differ significantly in the resource utilization, and we need some indicator to understand the correct split of those costs and the correct method to assign indirect expenses to a specified type of the product. And the cost driver idea is supporting this process. Actually, the cost driver is the direct cause of a cost, and its effect is on the total cost incurred. So how can we understand the reliability of this? A change in the cost driver will cause a change in the total cost of a related cost object. So we can't say that the cost driver, I'm sorry. Just a second. If we decide to identify the correct cost driver, we have to change, we have to look for the change of the total cost and decide with what cost driver, with what indicator it is associated. Cost driver should be diverse, so any one cost object almost always has numerous cost drivers, so we cannot stop on only one. In our cases, we have to look for the simplified models, but in reality, we can say that cost drivers are always multiple items. This term, I mean, the cost driver, is applied to companies in all sectors of economy and all types of organizations. So if the company is producing items, or if the company is providing services, so in every case we can identify the specific cost driver. And indirect cost cannot be traced to the cost object in an economically feasible way. The cost driver use is a critical point to allocate the indirect cost. So the cost driver is used not only to assign the direct cost to a specified product, but the indirect cost as well. What could be used as cost drivers? Here you can see some examples. For example, number of setups, machine hours, processed orders, completed orders, labor hours, or orders packed and delivered. So any example could be used as a real cost driver in the production company or in service company. For example, a number of labor hours could be used in both production and service area. How to perform the process of cost allocation using cost driver? First of all, we identify the cost objects. Then we move to identification the direct cost associated with the cost object. Then we move to identification the overhead cost or indirect cost. Then select the cost allocation basis and allocate overhead to the cost objects. So our cost driver and cost allocation basis are very similar definitions, because we use the cost driver to select the proper allocation basis. We do it differently under different costing systems. Job order costing is the first costing system. It is used when products produced are unidentical. Job order costing is also used extensively in service industries and in the production industries if our products are really unique and specific. Activity-based costing is the second costing system, which also is very popular among production companies, and it assumes that the products are the cause of resource consumption and therefore bear the indirect cost on products in accordance with the volume of production of each product. So activity-based costing is fully based on the cost driver definition. It is fully based on activity analysis, and it means that we have to select the proper cost driver in order to allocate our costs correctly. And today we start with job order costing. So to this very moment, do you have any questions?
No questions.
Okay. Job order costing is a costing system which is used when many different products are produced each periods. When your products are customized and they are not equal. If, for example, you are serving some unique dresses for theaters or for musicals, so you may use the job order costing. We can see some examples of companies that would use job order costing method include, for example, Boeing. Each airplane is the specific job, is a specific order, which is not the same for different customers. Bechtel International, this is a company which is providing large-scale construction, and each building is unique and each construction is unique. Walt Disney Studios also use the job order costing method to produce their movies. And we can list many other examples of job order costing. Now I would like to recommend you to discuss what is job and cost driver for specified type of the business in order to understand how these definitions would be modified within the particular industry. So could you give some examples for each industry, for each type of the business? What would be the job and the cost driver for hotel business, for example? Mm-hmm. Okay. If there is no discussion, I think we can discuss it during the practical session. And let's discuss how to perform this job order costing. Maybe after that, you will understand it better, how to select the proper driver and how to perform the analysis. First of all, we have to identify the cost flow. We have to understand what materials are needed for each job. Job would be the particular order from the specified client. Job may be the part of the order which includes the specified product. For example, Levi Strauss clothing factory would typically make many different types of jeans for both men and women during a month. A particular order might consist of 1,000 bootcut men's blue denim jeans, and this particular sort of jeans is a specific job for this factory. And if we produce 3 types of jeans, we use 3 jobs, and we split direct materials and direct labor between those 3 jobs, for example. So we can calculate how many fabric we need to produce the men's blue denim jeans or women jeans and so on. Then we assign direct labor. We directly split the working hours between job number 1, job number 2, and job number 3, and therefore there is no difficulty in calculation of the total direct labor cost associated with the specified job. I think this cost flow step number 1 is the simplest one. Then we need to split the indirect costs, which is also called the manufacturing overhead, because they are expenses associated with the production, but not directly. For example, for the jeans manufacturing factory, indirect cost may be the cost of electricity used to drive the sewing machines. It would be the cost of threads used for jeans, it would be the cost of paper patterns used to cut those jeans and so on. And we should somehow split the total indirect cost between job number 1, 2, and 3. But how to do this? Because we can't identify exactly what should be the portion of electricity that is driving machines in those hours while they are making men's jeans, for example, that belongs to job number 1. For this purpose, we should calculate the specific value, which is called overhead rate. So we have to calculate the overhead rate and later associate this rate with a specific job. And to make this association more correct and documented somehow, companies are using the specific document, the job cost sheet. Job cost sheet is the special document which includes the information about direct materials, direct labor, and manufacturing overhead. And here you can find the information about the cost driver. You can see here that manufacturing overhead is a heading, and here you can see the hours. So it means that our cost driver isn't based on hours that our sewing machine drivers are working over this job. And then if we identify the elements of the cost, we sum up it to the cost summary and calculate the total cost and the total and the unit product cost. And this rate is also called the predetermined overhead rate, and used to apply the overhead to jobs, and it is determined before the period begins. That's why it is called predetermined rate. But to calculate this value, we need to divide the estimated total manufacturing overhead cost to the allocation base for the coming period. And the allocation base should be our cost driver, for example. Direct labor hours, direct labor dollars, or machine hours, any allocation base that is driving our total cost. So how to compute this predetermined overhead rate? We would use the 4-step process. First of all, we estimate the total amount of the allocation base. So the total amount of working hours spent to all the jobs performed during the particular period. Then we estimate the total fixed manufacturing overhead cost for the coming period and the variable manufacturing overhead cost. If we are making similar or quite if we make some similar products, we can use historical data to calculate the coming period value of the volume of production. If our products are unique, we can use some subjective forecasting methods in order to understand what we plan to do in future in our coming period. Then we use the equation, the regression equation again, to estimate the total amount of manufacturing overhead and then compute the predetermined overhead rate. Let's see the example. This company, PRCO, estimates that it will require 160,000 direct labor hours to meet the coming period's estimated production level. So they used this information to calculate the overall value of the total manufacturing overhead, and knowing the value of direct labor hours, and in our case it means that direct labor hours are the cost drivers. We divide our estimated total overhead by the number of labor hours and calculate the predetermined overhead rate. It means that this value is associated with each labor hour spent for the particular job. So a cost driver is a factor such as machine hour, bed occupied, computer time, or flight hour that causes overhead costs. So if our cost driver changes, but cost is not changing in relation to this, we have to find another cost driver, or we have to decide how many cost drivers do we have in our product. So if we use the job order costing, we may use several basic operations. First of all, we purchase materials and issue them to the production. Then we purchase direct and indirect materials and use different accounts to allocate direct and indirect materials. And we have to use the labor cost information to assign the indirect labor to a specified account. So you know that direct materials, direct labor are assigned directly to work in process, which is split to sub-accounts in accordance to the number of jobs. And our indirect expenses are set to manufacturing overhead, which is only one account per all the jobs that we plan to perform during the period. So the sequence of steps is the following. We first of all work with the account named work in process, and then use transactions to make correct assignment of finished goods. So if you want to do this job correctly, we need to follow specific steps in order to understand the cost of the job. First of all, we have to identify this job, then trace direct cost of the job using the transactions presented above. Then we should identify the indirect cost using the total manufacturing overhead account. Then we apply the indirect cost to the job using the predetermined rate. And at the end of the period, we have to make some adjustments related to the recognized portion of the predetermined overhead. Finding total cost by summing up all the cost components. So at the end of the period or before the shipment of the job results to the client, we have to sum up all the costs and calculate the cost of the job. Step number 6 is closing the under or over applied manufacturing overhead, the cost of goods sold, and income statement. Under applied or over applied manufacturing overhead, it's an incurred manufacturing overhead, which is calculated using the predetermined overhead rate. But in case we are wrong with the volume of production or with the predetermined overhead rate calculation. For example, we calculate this rate assuming that we will use the full capacity of our production area, and we will calculate it for 1,000 units of product that we plan to make during this year. But actually, we have done only 900 units, but not 1,000 units, and therefore our manufacturing overhead is underapplied because we used the smaller overhead rates to assign the overhead amount to the specified job. When we bring in order our under and over applied manufacturing overheads, we calculate revenue and profit. So these 7 basic steps are needed to perform if you want to apply this system. So let's see the case how this cost sheet helps to assign the manufacturing overhead to a specified job. Let's return back again to our entrepreneur and see the data about operations associated with a specified job order 203 that consists of 50 t-shirts. For example, this guy may produce 50 t-shirts for a specified shop, I mean retailer, or for the specified musical group, for example, as a merch, and so on. And we can see that we have a list of expenses, and additionally we have information about the total volume that this entrepreneur plans to produce during the period. Let's see how to do it in step by step. On step number 1, we create a job and create an associated job cost sheet in order to start the accounting process. Step number 2 require creation of materials requisition form. If it is relevant, if you are working within the big organization, of course, it's needed. In case of small business, it's not so obligatory, but still could be helpful. So then we calculate the direct cost, summarizing direct materials spent for each t-shirt and multiplying by the number of shirts in this particular order. And we calculate that material A, shirts, used for $250, and material B, which is ink, is used for $100. And therefore, direct materials cost is equal to $350. Next step is to create an employee time ticket if relevant. If it is not relevant, we can use the Bigtrix system or some other accounting system to calculate those working hours spent to prepare this order. And we can see that our employee spent 7 hours and his wage is equal to $100 because we pay to our worker $2 per each t-shirt. So direct labor is equal to 100, and our cost summary will also include this value. Then we calculate predetermined overhead rate and assign overhead to the job. Then cost driver is a unit in our case because we pay to our employee per each unit, and we use ink per unit and so on. So our cost driver is a unit in our case, and we calculate manufacturing overheads, summarizing all indirect expenses, and calculate this total value, which is equal to 216. And our total number of units that this entrepreneur could produce per period is 1,200 units. And calculate predetermined overhead rates, dividing 216 by 1,200. It's 0.18. And this predetermined overhead rate is going to the job cost sheet. You can see this rate. And we multiply number of units which we make within the particular job by this rate and calculate the overhead amount associated with the specified job. So we can see that $9 of overhead is associated with our job number 3. So we sum up all the expenses and calculate the total cost, which is equal to 459, and unit product cost, which is equal to $9.18. So this is a total unit product cost. So job order costing, managerial perspective, I think we will discuss next time, as I think our time is gone. Any questions related to this part? Is it clear how this job order costing system works?
Yes, it's clear.
Good. So I think we can do this in a more detailed way during practical sessions. So if you would have some questions, please let me know in our chat, which will be leave. And don't forget about reading books. If you have some difficulties with obtaining books from our library, please let me know. We can do something with this, because you need to read something except lecture materials. Okay? Please don't leave it idle and let me know what is the problem regarding reading books, and we can organize the process. If there is no questions, thank you very much for coming. Thank you for your activities, especially girls, Karina, Elizaveta, Gulnaz, thank you. Polina as well. See you next week. So have a nice day.
Thank you.
Goodbye.
Thank
Bye.
you. Bye.